Nabila Mohammed, research analyst at Chapel Hill Denham, joins me to unpack this. Thank you so much for joining me today, Nabila. Now, recent data shows domestic participation in the NGX has shot up from 88 to 89% to 94%. Now, while we understand this can be somewhat beneficial for the market, like we always say, don't you think there is something we're probably overlooking? I mean, why exactly are they leaving? Where exactly are they moving their money to? And, are they going to the fixed income or taking this money out of Nigeria? What's happening? Talk to us.
So historically, what you will notice with foreign participation is that they tend to follow the trade in terms of carry opportunities. And interest rates in the fixed income market has remained elevated for the longest time. In fact, the open market access that has already been placed based on what we saw from August 12th is going to allow for more participation in that space. But if we look at capital importation data, bulk of the monies do not necessarily go to the equities market. They actually go to the fixed income markets, money market instruments, and that is where they are rotating these monies to. That is one in terms of capital flows, and just looking at how historical trends has shown us that bulk of the foreign investors' participation is not necessarily skewed to equities, but rather skewed to fixed income instruments. Now, secondly, we also have the situation where there's this delay in terms of reclassifying Nigeria back to the Frontier Market Index by FTSE Russell. And this is an index that foreign investors, foreign portfolio managers always track in order to know where they should carry their funds to. So I would say that it is bulk of what is happening in that way, because it has nothing to do with the FX landscape. FX landscape used to be the issue for foreign investors investing in the equities market and even in the market as a whole, because they are scared of how repatriation would be difficult. But the transparency that we're seeing now already cater to that issue. So it has nothing to do with them having it difficult in terms of repatriating funds. It's rather them chasing what is also available in terms of yields in the market. And lastly, let's not forget the fact that these particular foreign investors are looking at the whole new tax regime in terms of capital gains tax, and how there is still some level of lack of clarity in terms of how to be implemented. So these are some of the things that they are putting in their minds as well, and that's why we're seeing that domestic participation is high. Another thing that I must also add in terms of domestic participation is that at the start of this year, we noticed that the pension, that's PENCOM, adjusted upwards the limits that pension fund administrators can allocate to equities. So that again has, brought in more money or more flows from the PFAs that are domestic to, bolster up their participation, and that is what has largely supported the domestic participation. So it's not as if foreign investors are running away; they are following fixed income instruments that are high yielding currently, and the real returns on that too is positive, because inflation is 15.43%. versus what we have in terms of the yields that are around 17%, 16%. So there's real return, and that is really what is just that rotation is